Hello everybody. Today is March 28th of 2022 and today's video is called Headwinds. Potentially a less than pleasant subject, as this video is going to be about the difficulties that lie ahead for us as investors in 2022 and probably 2023. So the things that I view as being a bit of a problem right now are: the Federal Reserve is going to need to raise interest rates and deal with inflation, hopefully without killing the economy. Second, geopolitical events. Now COVID is kind of off the radar, and geez, all of a sudden we have a Russian invasion of Ukraine, and realistically the biggest crisis the world has seen in the risk of global warfare conflict since the Cuban Missile Crisis. Next is inflation itself and the danger that it poses to the economy and the pain that it inflicts upon the consumer. The other headwind is the need to unwind a massive asset bubble. Well, probably the worst asset bubble that we've seen in modern history. We've got headwinds of politics and media. We've got midterm elections coming up that look to already be of an epic proportion. And the rhetoric that we are going to experience is something that is usually not seen in midterms. It's usually for the presidential elections, but I would imagine that these midterm elections are going to be quite fiery. So the other thing we have to deal with right now is public overconfidence. And finally, I'm going to finish the video discussing the potential investment answers and how I plan on proceeding through these times. And so let's start with the first subject, the Federal Reserve. So just recently, the Fed raised interest rates by a quarter point. The Federal Reserve has been widely criticized as being too dovish and being slow to act, asleep at the wheel, and being one of the root causes of creating many of the problems that we have today: the asset bubbles, the inflation, which is the worst since 1982. In 1982, interest rates weren't 1 or 2%, they were 20%. The Federal Reserve is going to raise interest rates in hopes of slowing down the economy without destroying it. That can be a tough task. They talk about, when you hear the discussion about a soft landing, that's what they're talking about. In 1982, there was no soft landing. There was massive unemployment. There was a huge contraction in the economy, a big, nasty recession, and supposedly that cured inflation. They attributed it to Paul Volcker's massive rising of interest rates. But it was a painful event. Now, once that painful event had ended, the stock market did extremely well until 1987. The effort to raise interest rate is underway. The other thing is the balance sheet. You've probably heard, or maybe you've heard, maybe you haven't heard, the Federal Reserve has accumulated a balance sheet. Now, not too long ago, this balance sheet of investments that the Federal Reserve had, the things that they had bought up to try and manage the economy, was about $1 trillion. Today, it's $9 trillion to $10 trillion, based upon what news source I'm looking at and in which month here lately. So let's just assume it's $9 trillion. Now that's a lot of money. To put that in perspective, if they need to liquidate the balance sheet of bonds, it would take 9,000 mutual funds to buy $1 billion worth of bonds off of the Fed balance sheet. So this is becoming a bit of a problem. The Federal Reserve right now may have the lowest credibility with business and the public in its history. Now, the Fed is being slow to act, to put it mildly. One would wonder, you could see the housing bubble, the stock market, and the economy just zooming away. You may have seen my video called Boomflation a number of months ago. What were they thinking? Why were they not raising interest rates in effort to guide the economy to not overheat itself? Well, that question is, I guess, a subject of its own merit. So the thing is, this dovish Fed may be met with an excessively hawkish Fed, meaning raising interest rates excessively, like they did in 1982, in response. So I hear all this ridiculing going on, and I know people are laughing now. They may not be laughing later. In fact, I doubt they will be, because the aimed goal of this, if you're trying to bust the bubble, there's a lot of people that are playing with this asset bubble right now that will not be all too happy to see their personal fortunes evaporate. So it's going to be very, very interesting to see how this turns out. So in that line, the Fed could very well become a political target as part of these midterm elections and then the next presidential election. One would argue that the Fed has also painted itself into a corner by lowering interest rates and by political giveaways over recent decades. There's not a whole lot left. What would if things go bad now, how low can you lower interest rates? You've got a public and a corporate system now that's becoming addicted to bailouts and cheap money. So at some point, this whole managed economy system has it has some risk of failure, in my opinion. Anyway, and I don't think it's just my opinion. This isn't just a domestic problem. We have rampant inflation, just like in the 70s and 80s. It's a global event, and each country right now is dealing with this. Some countries are a little bit ahead of where the United States right now is in trying to raise interest rates. Brazil and England come to mind just immediately off the bat. Also, as there's long-term interest rates, there's short-term interest rates. We are already seeing signs that the short-term interest rates are actually being met with, instead of long-term interest rates going up in a sloped fashion, that there's the risk that they invert. When the yield curve becomes higher on the short end and longer on the long end, this is saying that this is going to destroy or damage the longer-term economy. So pay attention to the comments about the inverted yield curve. In essence, the Federal Reserve was created in the aftermath of the Great Depression. It is starting to take a shape and a route that no fundamental economist of that time would have said that this was an appropriate, reasonable thing to do with the national economy and the government. This is becoming Frankenstein, voodoo economics. We're entering uncharted territory, and we are going potentially towards the unknown. That doesn't sound so good, does it? Okay. Geopolitical events. So we have Russia invading Ukraine. I don't want to get into any discussion about why and how or anything, but what it has done, it is causing a global supply chain cut, a dysfunction, and we've just started with this. Imagine if there is separation now in Axis and allied powers. What if China and India side with Russia along with Saudi Arabia? What will happen to currency, gold, raw materials, necessary elements of mining and raw materials? They either will become prohibitively expensive or unable to be found. So the risk to the dollar is an element of potentially financial warfare. Will World War III, for example, will it be a tank and armor warfare, a nuclear warfare, or will it be a financial war? We shall see. Or maybe cooler heads prevail in this. It's too early to tell. But the rhetoric that we're hearing and the hawkish warmongering of people calling for our own elected officials calling for the assassination of a foreign country's president. We have an alarming sense of propaganda journalism going on within our own country, which is something, in my opinion, that is fairly new to the scene. Being that the United States bought into global consumer production, offshoring of manufacturing, should we wind up with a massive separation of the global manufacturing and supply trade, the United States no longer manufactures or mines or creates resources that are vitally necessary for the American economy. How long will it take for us to fix that? Luckily, the United States is a huge country with vast resources, but it could take years to reconnect the economy to a fully domestic economy from what it is right now. The United States and other Western countries also, have applied sanctions on Russia. Well, there are reverse sanctions. There are elements of risk relative to our currency. Many of these other countries own United States government debt. What happens if they dump all that? What could be the effect on the dollar? So there's an enormous amount of risk there. The emerging markets of the world are an interesting element too. Being that Russia and Ukraine were part of emerging markets, at first, many of the emerging markets, BRIC funds, investment funds, were sold off in great way because they had Russian components to them. But look at Latin America. The door has opened for Latin America to become a producer economy, safe place, neutral element that might have significant value to the United States above and beyond what it's been before, or perhaps not. Maybe it's to both sides, or to the other side. So we shall see. It's a bit early to tell, but the geopolitical events today are the most alarming in my lifetime, and it appears that the American public, in my opinion, having grown up during the Cold War and gone to public school and private school later, the fear of nuclear war with Russia, the Soviet Union, the Axis powers was great at the time. I'm not sure people are at the same level of concern or awareness that we were in the 60s, 70s, and 80s. All right, third topic, discussing inflation. At 7.9% inflation currently, that's the worst in 40 years. To put that in perspective, if you have cash and you have inflation of 7.9%, your $100,000 will have the same purchasing power as $78,000 in just 36 months. This is why they call inflation the cruelest tax. So inflation, the definition is too much money chasing too few goods. Being that the economy was booming and and the Fed wasn't reacting, and we had COVID, and we had supply chains disruptions, we have too few goods. The car manufacturers cannot keep up with demand for the fact that they don't have all the necessary pieces and components to sell the finished product to the customer. Good news for them is, while their volume may be less than what they've wanted, the profit margins are at their highest levels. So you're seeing a lot of companies right now very profitable, but they have a little bit of a supply issue. So some companies would maybe actually prefer that. The problem, though, is much of the pricing today has not yet factored in the inflationary elements of raw goods, materials, shipping, fuel, or anything like that. It is coming. So if you think a brand new car today is expensive, What might it be in 3 years when you factor in all these things? And my question too is, some of the elements of electrical vehicles, which are being mandated upon us, whether we like it or not, by our current administration, for example, how do you A, make an electrical vehicle if you don't have all the nickel and lithium and all these kinds of things? But what if the price of those raw materials has doubled or tripled? Rivian, which just went public, electric vehicle maker with wide ambitions, had to tell its 50,000 customers that had ordered their car that the cost of the vehicle was going to go up by $20,000. So obviously an area of concern. The government has engaged now for a fairly good amount of time is playing Santa Claus. It really became an issue after 2008 and 2009's economic collapse globally, where we just simply printed up more money and forgave bad debts, and kumbaya, we went on with life, and nobody was punished for any of their misgivings. A few companies were collapsed and folded into others. I worked for Washington Mutual, which eventually became part of Chase JP Morgan. But realistically, 14 years ago has already come and gone. People have forgotten about it. But ever since then, part of this problem right now is the government cannot simply give away money to businesses and people in hopes of creating happy voters and a stable economy. It's just not that easy. It doesn't work that way. There's a bill to be paid. Inflation right now, it's not just gas prices. It's food. It's raw materials. It's finished goods. It's manufacturing costs. And again, we haven't yet really seen the total detrimental effect into finished goods quite yet. It's going to get worse, much worse. The trouble with inflation is it eventually prices itself into the system. The trouble is, as inflation becomes bad or it starts up, it slows the economy. People wind up unemployed. Wages do not keep up with it for the fact that the economy is slowing. The corporation doesn't necessarily need to or be able to afford to give wage increases. But we haven't even got there yet. We have still not technically gotten into a recession. And the American public seems aloof to this. We still have people that are happily unemployed, collecting welfare checks, gaming the system to the point where we can't staff, a restaurant for breakfast, lunch, and dinner. We've got this voodoo economy, Frankenstein economy, where the will to work was undermined by financial giveaways. The supply chain failure is now getting worse, obviously. It was bad enough with just COVID and the recovery from that, but now with the global events, the supply chain failures are getting worse. They are getting to the point now, too, where the cost of global shipping, in many cases, is doubled, if not tripled. And so that's becoming a new issue. Rising costs at some point obviously start to create a dwindling appetite for goods and services. That slowing creates declining earnings. Declining earnings means falling stock prices. But most people just haven't put this forward element quite together yet. All right, on to asset bubbles. Number 4. So, when you've got way too much cash floating around, which was intentional, that money has to go somewhere. Well, it can be spent properly, or it can be spent frivolously. So, stock prices went up. A lot of the favorite stocks, the tech stocks, the go-go momentum stocks, the meme stocks, real estate has just gone through the roof. To the point where people can't afford to buy a house or even find a house for sale. I mean, I could go on. It's a separate subject in its own. Money can be spent intelligently or unintelligently, you've got these cryptocurrencies now becoming rather mainstream, but they're unregulated. They were outlawed in China and Russia, I believe. I think the United Kingdom right now is coming up with regulatory guidance on. The United States is. The question is, people insist that these things have a place in the global economy, but do they? A lot of people think they are a Ponzi scheme. There's wide debate about that. Don't want to discuss the merits or lack thereof of crypto, but it's part of the asset bubble. An area that had been cheap, but now in recent months is starting to change, are commodities. So the base of any manufactured product is raw materials and commodities. Steel, aluminum, copper, zinc, molybdenum, lithium, plastics, and then there's the agricultural side of commodities. Now we're starting to see these things increase significantly in value, almost in dangerous fashion. In some cases, the price of nickel more than doubled in just one day on the London Metals Exchange, and causing a massive margin call on a large Chinese company. And the nickel market was closed for over a week because of this. But again, not a video about commodities, but commodities are an incredibly important part of the economy. Without commodities, you can't make stuff. You can't eat stuff. Some examples of the asset bubbles. Dogecoin, actually known as Dog-E Coin, has never been a serious cryptocurrency. It's been a collectible. It was kind of a joke, a satire about cryptocurrency, but it became a meme coin, and at its peak value here in the last year or so, the total value of the Dog-E coin market was $85 billion. That's a lot of money. Should that go to zero, for example, well, all the people that owned it will have become, well, in their minds, poorer. 20% of houses in recent months have been bought solely for investment purposes. This wasn't so that somebody could live in them. A lot of it was vacation rental by owners. I just got back from a 4-month road trip with my dog in a trailer and traveled south United States. And I mean, the amount of housing being built along the Gulf Coast and the east and the southeast of the United States, the coastlines where I was traveling, there's a massive building boom there. But when I drove by at night, none of the lights are on. All of these houses are empty. They're only being used for vacation rentals. This is another issue with the whole housing market and the housing bubble. There is an artificial demand for housing for investment purposes that one might argue is unhealthy. I do believe, too, that at the peak of the 2007 financial bubble, housing bubble, the number was the same, 20% of houses being bought for investment purposes. 40% of the NASDAQ is actually the top 5 companies. If those 5 companies do very, very poorly, it could have a dramatic effect on that index and the people that do index investing. The credit spread right now, government bonds compared to corporate bonds, the difference in yield or interest payments being made for the risk that you take for a corporate bond compared to a government bond had been very, very, very little. So the credit spread was tiny. That's an indication that there's too much demand for yield-producing securities. Now that interest rates are going up and the Fed needs to delever its balance sheet, that spread should widen, and if it does, it's going to create losses for people that own those non-treasury bonds. With real estate, when a bank is going to grant a mortgage for somebody, historically, house prices don't go up 100% a year. So when a bank previously asked for a 20% deposit, that was a real piece of equity to lend upon. But if the real estate market becomes too volatile, there's not enough skin in the game by the owner of the property to satisfy the risk management of that bank. Now, in my opinion, the bank should be cognizant of this at this time. But as far as I know, I don't know of any direct measures that are protecting them. The risk is real. In fact, for the last several years, I have noticed some very strong similarities to the dot-com Y2K bubble of the mid to late 90s. I've been a financial advisor since 1992, 30 years. I see the same potential bubble burst of the dot-com Y2K area with today's technology stocks. So many similarities. And then the housing bubble of today being so similar to what I saw as a Washington Mutual employee and looking around what was going on lending back then. I'm deeply concerned that we're going to see a combination of the bust of 2000-ish, 2001, and 2008-9 put all together. Heaven help us if that happens, but honestly, I am beginning to wonder how that can't happen. And worse yet, we're already seeing signs of the slowdown. The NASDAQ, S&P 500 appear to have peaked in November of 2021. We've seen some downturns. Now in the month of March, we are seeing some upticks right now in the stock market, in the tech stocks, but it may very well just be a dead cat bounce. The level of decline, not just in the United States, but across the world, has been rather significant. So much so that in the Hong Kong market, that's known as the Hang Seng, the Chinese government finally had to step in and say, hey, market's gone from 36,000 in recent years all the way down to 18,000. We're going to stop. We're going to step in and fix this. And that has created some temporary relief. So the housing market now, we're already starting to see signs that mortgage refis are down 50%. New mortgage applications are down sequentially now for, I believe, 4 months. And now we have higher interest rates. Anyone that thinks that you can have meaningful increases in interest rates and still have housing prices go up when the Fed is actually trying to stop asset bubbles, I don't know where their mindset is. But it's pervasive in today's society. People seem to believe that it'll just go on forever. We are seeing that people today, and it's a bit surprising, it's been 14 years, I guess, since the last really, really bad market. People seem to have a very difficult time in separating the concept of a good company or a good piece of real estate and whether it's actually a good investment. A company can be a fantastic company and it could do very poorly. A great example of that was Microsoft. In 1999, Microsoft was an amazing company, but the price had gotten way ahead of itself, and it would decline in value and stay down for 13, 14 years before it would break even to its previous high of 99 or early 2000. In fact, that was the entire tech stock market. So people that think that we're going to see a short-term correction in tech stocks just to see a massive rally again, well, if it does that, it'll be the first time in history that you see an entire sector go from a bubble to a bust and then a recovery. These things can take quite a few years. So I think people are a little naive in thinking that, oh, the worst is over, everything's going to be fine, and it's just going to continue. The market finds new favorites. This year, the new favorites are industrial metals, commodities, and oil. Oil prices were so ridiculously cheap that the entire global energy, dirty oil side of things at President Biden's inauguration was completely priced at bankruptcy. It wasn't just U.S. energy stocks either. It was the global supply. So here you have massive demand with extremely low prices, And now we see the prices, going up meaningfully. So my final point on politics and media, this is subject number 5. We're entering a society that appears to be something for nothing. There's massive contention right now in the United States about the culture war, for example. Midterm elections are coming. There appears to be signs, fairly strong signs, based upon the resignations of existing members of Congress, etc., that the Republicans may very well take over both houses. There's already talk that the House of the GOP would immediately go to work at impeaching Joe Biden. Whether that's a valid thing or not to do, it will be a distraction to American society and business and industry and the cohesiveness of the American society. There's now also talk about price controls. It's amazing. The political establishment now has been doing everything they can to try and destroy domestic energy supply. But now, because of the failure of controlling inflation by the Fed and policy, now that they're actually profitable, you hear politicians saying that they want to punish their success and create windfall taxes on them. Well, heaven forbid we become like some sort of a Soviet-era society where we reward failure and subsidize it, and then punish success with excessive taxes. In fact, Biden administration in the last day or so is now talking about coming up with a special punitive tax for people that make $100 million or more. Those people could just move to another country, right? You could scare away all the capital from your own country. This is a bad idea. Fair taxes, yes, but punitive taxes for success and rewarding a failure, that is a recipe for Marxism. So this endless Santa Claus thing needs to come to an end. The mandating of electrical vehicles. Well, geez, if the cost of a Tesla goes from, say, $100,000 to $500,000 because of a lack of materials and electricity, then it's not going to work. We can also go on by talking about the politics of global censorship, the fears of tyranny. In countries as free as Australia and Canada, we've seen signs of this, and Austria. We have these big tech companies that are controlling our lives more and more and more. This is becoming a contentious area. So the politics and the media are a big part of where we're going. The government now, too, has become so generous with the government coffers that in 2021, we ran a $2.77 trillion budget deficit. That was just the budget deficit of the government. That equals the entire gross domestic product of many large industrial Western nations, such as in Western Europe. And in 2020, because of COVID, we had a $3.13 trillion deficit. And we thought the budget deficits under George W. Bush during the war on terror of $1 trillion were terrible. We're tripling that now. Eventually, this stuff means real money. The national debt being at $30 trillion roughly right now. If you just keep on tacking on $3 trillion a year to the national debt because you spend more money than you take, that's a problem. So how do you balance? How do you create a balanced budget? You need to take in as much as you spend. How do you do that? Well, there's two ways. You can grow the economy, which right now does not look very possible in the short term anyway, or you can raise taxes. Well, that would make the bad economy even worse. It's an unenviable situation created by our own doing. Okay, my last subject of Headwinds is public overconfidence. It is you, your neighbors, your friends, your relatives. In my life, in my 30-year career, and I've read enough books to stack up to the ceiling about finance and economics. I'm very concerned. And the way I'm running my business right now reflects it. This is the most conservative or defensive that I've been during my entire career. But I see with the public right now that there really isn't that much of a sense of fear. I don't see any panic. I don't see any concern yet. And this is very similar to what I saw in the spring of 2008. In the spring of 2008, when I was at Washington Mutual, we started to see signs that there was some real trouble brewing with the economy. So as a financial advisor back then, I took a massive pay cut. Things were going bad. By October, Washington Mutual had gone bankrupt. But in the spring of 2008, before things really got bad, there were some very telling signs of trouble going on. But the public, being that it's not their occupation or understanding or education, they didn't see it. They would feel it later. And I think we're kind of at that same point that I saw in the spring of 2008. There is the risk that something here happens. The credit markets in 2008 in spring froze up. The commercial paper markets were wiped out, and all of a sudden there became illiquidity. And they didn't have $9 or $10 trillion on the balance sheet of the Fed that they were trying to unwind. Now, if the economy starts to collapse, I could hardly see the Fed being successful or even attempting to unwind the balance sheet in that bad of a market. But I'm kind of curious, why weren't they unwinding the balance sheet as the economy was growing? But I don't know. The public has become engaged in passive investing over managed investing. So for example, instead of buying, for example, an investment portfolio managed by a person or a team of people that were actively managing opportunity and risk, people decided that since indexes were somehow generating better returns than something that, timid, that the public has gravitated towards S&P 500 and NASDAQ index-oriented products. And the better they do, the more money they throw at them. So it becomes this ever-growing bubble, Ponzi scheme, whatever it may be. People just keep throwing more and more money at it. The top 25 mutual fund index-oriented positions in the United States, they are almost all passive indexes. I remember looking in 1999 at the top 10 or 20 mutual funds and seeing that at that time, all those mutual funds were investing in the same thing. Well, these indexes, they're all investing in the same thing. So in the end, all investors have the same portfolio. They have over concentration in these stocks that have been the winners of the past. It's hard to play defense if your entire portfolio is top weighted of things that are overpriced, and during a liquidation event where people are selling, the unwinding of those holdings, should we have more money leaving the investment markets than coming in, the painful element of losses could be significant, as they normally are in a bad market. The other thing that's become a problem over the years is with globalism, we have more and more correlation. For example, the stock market of one country compared to the next country, to the next country, the next country, they are rising and declining in unison with each other instead of going opposite to each other in certain elements. In diversification, a good diversification is reverse correlation or opposite correlation or not near complete correlation, because if you have a portfolio that's going completely up or down at the same time, it doesn't provide much in the way of defense. Today, a very common element of investing today is, well, why did you invest in that? Well, because it goes up. Well, what do you know about the company? Nothing. Well, why'd you buy it? Because it goes up. Well, everyone's buying it because it goes up. So basically, the entire purpose of this investment is simply because it goes up. Yep. Well, guess what? That'll go down, because in the end, it won't have any fundamental value to it. There won't be any bank accounts, there won't be any real estate, there won't be any profits, there won't be any dividends. It'll just be a stock with a really big price tag to it. It's amazing. It's only been 14 years, which seems like the blink of an eye to me. But these days, I hear people say that house prices only go up. Anything that can go up can go down. And certainly, anything that's gone up a ton in a very short period of time can go down a lot in a short period of time. In fact, financial instruments can lose value quicker than they can go up. So if something went up a ton in 36 months, that entire amount could probably be unwinded in a matter of months as well, if not less. Remember, you only have to lose all your money once to have a lifelong impact. Bailouts and handouts have created a risk-hungry public. There hasn't been any punishment for really bad behavior. That will come back to haunt people, and perhaps American society. So we shall see at what point this public overconfidence becomes corrected. But it's something that I'm looking very carefully at. If you are a client of mine, I'd love to hear your comments about what you hear in your circle of friends and cocktail parties. And again, there's going to come a day fairly soon where the public realizes that there is trouble afoot. And in a way, it'll be a good thing, because until the public realizes that there's a problem and we see the telltale signs of it, the end of the troubles can't come until they start. So how can the economy improve if it hasn't yet become somewhat damaged or declined or crashed or whatever? So we are in the beginning of a economic slowdown that, in my opinion, I think there's almost a certainty that we wind up in a recession. But again, we will see. So in the end, what is the answer? Well, I tell you what, that sounds so dangerous. I'm just going to take all my money, I'm just going to put it in cash. Remember, I told you, 8% inflation. If you took $1 million and just shoved it in a bank account, it'll have the same purchasing power as $780,000 in just 36 months. It's not a very good idea. Stocks. Hey, aren't you supposed to buy stocks to fight inflation? So, if you buy a company that makes goods, they will raise the price of the goods to offset inflation. Thereby, the company will make more revenue and then make more profit. That is true, but in the shorter term, as you raise prices, sales go down. In fact, they may go down a lot. And especially with stock prices being at all-time highs, and then some, the prices of stocks may be very much at risk. Now, is that all stocks? Maybe not all stocks. Again, the energy sector, the side of metals, maybe some emerging markets, maybe some of those stocks are not as grossly and frighteningly overvalued as other parts of the economy. There's commodities and natural resources. But in an economy that blows up, for example, in 2008 and 9, the economy got so bad that oil prices went from being sky high to rock bottom, because when the economy died, you didn't need trucking or shipping or commuting or anything. So the consumption of oil and energy declined and created a crash within that sector that had been very positive. Again, who needs steel, aluminum, zinc, molybdenum, lithium, and rubber and wood if the economy is horrible? So we see those things going straight to the moon right now, but if the economy gets bad enough, they will fall. And when they do, historically, they fall rather dramatically in a very short period of time. That was such the case in 2008 and 9. There's bonds. No matter what bond you buy right now, the interest rate is very low. The decline in bond values now since November is rather significant. And it didn't appear, the worse the credit quality was, you weren't being paid any more interest to it. So the bond market right now, I find very concerning. Short-term U.S. government treasuries as a way of protecting money in the shorter term for a later buying opportunity, maybe that's of interest. Gold. Gold has been a natural safe haven for times of concern and things like that. And right now we do have gold breaking new all-time highs. In fact, what we're seeing with commodities is almost identical to what was going on between 2003 and 2008. There is a very sharp rise going on right now. Emerging markets. Maybe it's safer to invest in some of these countries that are outside of these risks, or they've been downbeaten and downtrodden. I mean, Latin America has been cheap for a very, very long time. They've been fighting inflation, but they've also been raising interest rates lately. They're ahead of the curve compared to the West in raising rates. Maybe that's an answer. In the end, in the Great Depression, after a massive amount of inflation and a bubble, it led to deflation. There's the risk that we wind up in a deflated society. So the only answer that I can think of is try not to overguess this and use tactical diversification. Spread your money out, and if everyone loses 50% and you lose 20, you're net ahead. Your net rate of return actually looks pretty good. So now trying to avoid loss is a great way of creating loss. Trying to create outsized gains is also a great way to create losses. But running away from risk and responsibility creates risk. In the end, hey, we really don't know. Nobody does. We're soon going to find out. I've done this for 30 years. It's amazing. I meet people that have never done this job professionally. They're young. They haven't even been educated in finance and economics, and they think they know all the answers. I will tell you that myself and my colleagues that have done this for a long time, we're so humbled by what the market does to us typically over time, is that we've come to the realization is that trying to predict is folly. It's better to prepare. So right now, I am working to be prepared for bad times. I'm not trying to predict them, but whether the market does well or poor, I hope to be above average compared to others. I thank you for joining me and look forward to having you visit my next video. Thank you.